In accounting cycle, it is very important preparation of unadjusted trial balance, right? First, we are preparing the unadjusted trial balance. Then after that, we can prepare adjusted trial balance, right? Once we finish the preparation of unadjusted trial balance, then we can go for some adjustments. Maybe there are some adjustments, right? Sometimes maybe there may be some errors. Sometimes maybe there may be some detections, identifications of some transactions which is not recorded in financial, which is not posted into the GL, right? Then we have to adjust all those transactions once finish the unadjusted trial balance. There may be some situations now in trial balance. What we are trying to do is we are going to verify the credit balance is equal to debit balance. Sigma CR equal to sigma DR, right? That is the main purpose, right? We're going to verify that. Sometimes there may be situations the credit balance not tally with the debit balance. Total credit that is not equal to total debit. In that situation, what we have to do is we have another situation. We have another procedures, right? Using suspense account and temporarily balancing the trial balance. Later we are going to find what are the what kind of errors are there not to tally the trial balance. Then we can find errors and we can adjust those into the final trial balance. The accuracy of trial balance is very important. Why? All those financial statement, maybe profit and loss account, right? Maybe financial situation, right? Maybe balance sheet. All those, the accuracy of all these financial statements totally depend on the accuracy of trial balance, right? Today, I have one example. Sana traders, right? There are certain transactions listed here. This is relevant to January 1st to January 31st. Some transactions are there. January 1st, Sanath invested 500,000 LKR as capital. The owner has invested capital, that is 500 rupees. 500,000 rupees, that is the capital. January 3rd, purchase good worth of 150,000 for cash. Buying goods, that is 150,000. In January 8th, purchase goods on credit from Nimal for 100,000. There is another transaction, that is credit transaction. January 12th, sold goods on credit to Kamal for rupees 180,000. That is the credit sale. And January 18th, sold goods for cash amounting 70,000. That is a cash sale, right? 70,000 rupees. January 25th, paid building rent for January in cash, rupees 20,000. January 28th, owner withdrew rupees 10,000 cash for personal use. Right? There are many types of transactions, but I have selected few. Right. Now, this side, this is the structure of journal entries. This is the general journal structure, right? January 1st, 3rd, 8th, 12th, 18th, 25th and 28th. All transactions 1st, 3rd, 8th, 12th, 18th, 25th and 28th. Right. Now we have to pass journal entries. This is the general journal. January 1st, what was happened? The transaction in January 1st, that is capital investment, right? Capital investment. Then we have to mark what is which account debit, which account credit, right? Date column is there, details column is there. In detail columns, we have to indicate what is the account name, and F column, what is the GL reference number or the GL account, right? And debit column is there, credit column is there, right? In double entry policy, there are two entries for each transaction. One account to be credited, other account to be debited, right? That is the double entry policy, double entry rule, right? Now the first transaction is the owner invested 500,000 LKR. Once owner invest, the organization, the company, business receives money, right? Business receives money. Then we have to debit cash account. Cash account by 500,000. Cash account debited. Then we have to credit the, what is the account? We can credit capital account. We can credit the capital account. Then that is going to the credit column. Alright, that is going to the credit column. Right, January 3rd, there is another transaction. Purchase goods worth of 150,000 for cash. Now they have spent 150,000 from that capital, right, to purchase goods, right? Here we'll put this account is, we'll say GL1, GL2, right? That is the reference, right? GL1 and GL2. Then which account to be credit, which account to be debit? Debit account is the purchase account, right? Purchase account to be debited. This day is over. Purchase account debits, and we have spent money. Then we have to credit the cash account. Purchase account, we'll say that is GL3, and cash account, we'll say that is GL1. We have already identified that. And then cash account to be debited by 150,000, and purchase account to be debited 150,000, cash account to be credited by 150,000. Right. January 3rd transaction is over. We'll move to January 8th. Purchase goods on credit from Nimal for 100,000. Then again we have to debit the purchase account. If we have purchased something, then we have to debit the purchase account, right? Purchase account is GL3. January 8th, that is 100,000. I'm going to debit this account, and there is another new account. Why? Purchase goods on credit, then that is payable, right? We have to pay. That is, we have purchased on credit. If I buy something on credit, then we have to pay. That is payable. Then payable account, the trade payable account, that to be credit. Accounts payable, that to be credit by the same amount. Right. What is the transaction on January 12th? January 12th, sold goods on credit, Kamal for rupees 180,000. This is a credit sale. Right? Then if credit sale, they have sold goods but they didn't receive money. Right? They didn't receive money. Then that is receivable account. There are two accounts. One is receivable account and other one is sales account. Then we have to say trade receivable account will debit by 180,000. This is a new GL account. We'll say that is 180,000, and sales account, that is to be debited by the same amount. Finish. January 18th, there is another transaction. What is it? Sold goods for cash amounting 70,000. Now they have received cash, right? Cash received in that case. That is not a credit sale, that is a cash sale. Then we have to debit the cash account first. Cash account, that is GL1, 70,000, and sales account to be credited in the same amount. Sales account, we'll say the sales account is GL5, 70,000. January 25th, paid building rent for January in cash. Paid building rent for January. January building rent has paid, that is in cash. Then the cash account again, we have credited, and there is new GL account, that is building rent, right? Building rent expense. Rent expense account, that is GL7, right? Rent expense account debited by 20,000, and that has paid by cash, then cash account, that is GL1, credited by 20,000. Now owner withdrew 10,000 cash for personal use. Owner is withdrawing 10,000 rupees amount, right? That is drawing. That should be a drawings account. Then we have to debit the drawings account. Drawings account debited, we'll say that is GL8 by 10,000, right? That has withdrawn in cash account, that is GL1, credited by 10,000, right? That is debited by 10,000. Now we have passed all general journals, right? All journal entries we have created, right? Once we create the journal entries, the next step of accounting cycle is posting those in where? The general ledger, right? Then we should identify what are accounts we have to post, right? There are 1, 2, 3, 4, 5, 6, 7, 8, up to 8, right? There are 8 GL accounts. Now I'm going to prepare all T accounts. Next step is preparation of T accounts, indicating what is the debit balance. The purpose is identifying the credit and debit balances, right? We have to extract all debit and credit balances to prepare unadjusted trial balance, right? That is the purpose of identify the balance, right? Okay, now we'll go for that. You can copy these, right? You write this somewhere. If I don't have sufficient space in the whiteboard, then I have to delete this too. I will keep it as it is still. Right. What are the accounts? First, we will pass entries to cash account, right? GL1 cash account. We'll say cash, right? This is the debit side and this is credit side. What are the debit entries there? January 1st, there is a debit entry in cash account, right? 500,000 debit entries there, January 1st. Then January 1st, 500,000, right? In cash account. Again, January 3rd, there is 150,000 debit account. January 2nd, there is 150,000 debit account. Debit 500,000. No, this is purchase account. Yes, January 18th. January 18th, there's a 70,000 debit, right? And credit account, January 3rd, there is a creditor. Jan 3rd, there's a credit side account, that is 150,000. 150,000. And January 25th, this is January 3rd. January 25th, there is another entry, that is rent. $20,000. And January 25th and January 28th, there is a 10,000 withdrawal. January 28th, there is a 10,000 withdrawal. Right? What is the balance? Here, balance is, total is 570,000. Here balance is 580,000, right? What we're going to do is, I'm going to take the same value, 570,000, and balance, right? Balance CD, balance carried down, what is it? 390,000. The sum of this, deduct from this, then you can get 390,000. 390,000. Right? Then this is the balance of cash account. In cash account, there is a credit balance 390,000. That is the meaning of it. Right. Then we'll prepare cash account. After that, we'll go for capital account. Capital account. In capital account, January 1st, there is a credit balance. January 1st, there is a 500,000 credit balance. Right? That's it. Then the balance is 500,000. After the initial capital investment, there is no any capital investment, right? Then what I am going to do is balance CD, that is 500,000. I'm going to balance the account 500,000, right? This is the balance of capital account. There is a debit balance in capital account. End of month of January. Right? End of month of January, there is a debit balance of capital account. Next, the purchase account. We'll prepare then purchase account. In purchase account, January 3rd, we have cash purchase. January 3rd, we have 150,000 cash purchase, right? And January 8th, we have, right? January 8th, we have another 100,000 payable. January 8th, we have another 100,000. Total is 250,000, and the balance here this side, balance CD is 250, and we are going to finalize this at 250,000. Finish. Purchase account is over. Right? Then go for trade payable account. Right? Trade payable accounts. Trade receivable. That is 180,000. And 100,000. This is trade payable account. Accounts payable. This is trade payable account. Trade payable account, debit side and credit side. Trade payable account, there is only one transactions, that is on January 8th, there is a cash purchase, right? January 8th, there's a cash purchase worth of 100,000, right? The total is 100,000. Is the balance of this account, trade payable balance, right? Then trade receivable account, trade receivable account. In receivable account, we have 180,000 transaction in January 12th. January 12th, we have 180,000 transaction. That's it. Then we can, total is 180,000. 180,000. Balance CD, that is 180,000. This is the balance of trade receivable. Now 5 accounts is over. We have another account, trade receivable, then sales account. Sales account, DR and CR, debit and credit. In sales account, January 12th, there is a credit entry for sales account, right? That is 180,000. What is the amount debited in trade receivable? That has credited in sales. That is normally happening, right? 180,000. That is January 12th. And January 18th, there is a cash sale. January 18th, no? Yes, 18th. There is a 70,000 worth of cash sale, right? This is 250,000. Total 250,000, right? Then balance $250,000, right? We have another two accounts. Right, we have another two accounts. One is, we'll take this little bit up. Right, what is that account? We have two accounts, drawing accounts and rent expense, right? Rent expense account, debit side, credit side. In rent expense, we have debit entry, January 25th. That is 20,000. right? Then the total is 20,000. Total is 20,000. Balance CD is 20,000. Then there is a credit balance, right? There is a credit balance. And the last account is drawings account. Let me take this little bit up. 250,000 and 250,000. Total. Drawings account, debit and credit. Drawings account, there is a transaction that is 10,000 has withdrawn. Drawings accounts, that is debit entry, right? January 28th, there's a debit entry that is 10,000. Total is 10,000, right? And balance, that is 10,000. Right. All 8 accounts, double entries we have passed. Capital account, cash, credit, purchase account, trade payable, trade receivable, sales, rent expense, and drawings account. Right. Now we are going to prepare the balance, unadjusted balance sheet. Right. Unadjusted balance sheet. We'll say this is Sana Traders as at January 31st or 2006, you know that you can put it. Right. We need 3 columns for unadjusted balance sheet. Right. We need 3 columns in unadjusted balance sheet. What are those? Account title, debit entry, and credit entry. Right. Account title, debit, credit. Right. We'll start from cash account. Cash account. Cash account, we have credit balance, that is 390,000. 390,000. We have a debit account. Right. Then there is a balance for credit. Now this is less, this is greater. Then what is the balance? 390,000. That is debit balance. Right. That is debit balance. Right. That is debit balance. That is 390,000. right? Cash account has a debit balance, capital account has credit balance, right? Now, trade receivable account. First, we will list down all trade receivable account. We have trade receivable account. We have 180,000 debit balance. Right? And purchase account. Purchase account. Purchase account we have debit balance that is 250,000. Right? 250,000. Rent expense account we have 20,000. And the drawings account we have another 10,000. Now 1, 2, 3, 4, 5. There are another 3 credit balances where capital account we have 500,000, right? 500,000 credit balance, right? Credit balance and capital account 500,000 credit balance, and trade payable account, trade payable account we have 100,000. Trade payable accounts we have 100,000 credit balance, and finally the sales account we have 250,000. All 8 accounts are finished. Sales account that is 250. 250,000. Right. Now we'll get the total. What is the credit total? 390, 180. Right. It is 850. 5, 6, 7, 8, 50. Right. There is no any difference between debit and credit. That means debit column and the credit column totally balanced. Right. Then we can use this unadjusted trial balance for adjustments and final accounts, right? If we don't have, if this credit balance and debit balance is not tally, if there is a difference, as an example thing, this is 80,000, 850,000, and this column is 800,000, but there is a 50,000, there is a variance of 50,000 rupees. In that case, what we are doing, then we can add a suspense account to tally account in the tally trial balance temporarily. right? Finally, what we have to do, next step is we have to find all errors and we have to pass another separate journal entries for error correction. Once we identify errors and correct those in journal entries, the Suspense account balance automatically becomes 0 and that is automatically closed, right? We'll work out for another example with Suspense account scenario, right? Right. I think now you have certain level understanding about how to pass journal entries and how to prepare unadjusted trial balance, right? In this case, I'm not going to quote the entire example from journal entries, right? Here I'm going to quote trial balance which is not tally. The credit side and debit side is not tally, right? This is, we'll say, negotiation and traders. Negotiation traders. Unadjusted trial balance, we'll say January 31st, right? It is given us cash account title debit credit. Right. Cash account 300,000. Cash account, there is a 300,000 balance, credit debit balance, and trade receivable 120,000. 120,000. 120,000. And next, the purchase account 200,000. Right? These are GL balances extracted from the general ledger, right? Now here we are not going to prepare T accounts, right? That is already done. Now we have extracted those from the GL, right? 200,000 and rent expense. Rent expenses, that is 30,000, yes. 30,000 rupees. And sales account, there is credit balance of 350,000. Sales account 350,000. Sales account 350,000. And there is another trade payables, there is 80,000 credit balance. This is 80,000. Trade payables, that is 80,000 rupees. And capital account, that is 200,000. Right. Now we'll get the total. What is the total? Right? 350,000 plus 80,000 plus 630. Right? This is 630. Just I am writing here 600. This is 630,000 rupees. But balance of this is 300,000, 420, 620 and 650. Now we have detected there is a 20,000 rupees variance in this debit and credit balances. There is a 20,000 rupees variance. What can we do now? But we can't close this account in this situation. Right? We have another additional work here. Right? I'm adding here another column. Suspense account. Right? Suspense account. Suspense account's value is 20,000 rupees and 650,000. Now this is in unadjusted trial balance, not in adjusted trial balance. In next step, what we have to do is we have to identify all variances. What is the error? Then we have to correct that error in the next final trial balance. Right? In final trial balance, we have to correct the error. Right. Next, we have some informations in next step. What is the error? A credit sale of 50,000 was correctly debited in receivables account, but credited to the sales account only 30,000. There was a credit. There was a 20,000 variance. Right? 20,000. There's a 20,000 rupees variance. Right? Right. Okay. Now what we are going to do is this next final trial balance. Right? In the final trial balance, we have to extend this table. Right? Right? Not this down. Right? This is the adjusted trial balance of Niroshan traders. How are we going to adjust this? Right. I'm going to keep this as it is. Right? I'm going to keep this as it is. I'm going to prepare separate set of journal entries for these error corrections. Right? There are main three error corrections. Right? One is error, what we have detected, and other two are adjustments. What are adjustments? Normally, there are adjustments what they couldn't enter into their journal entries, right? Now, today is January 31st as an example. Assume today, January 31st or February 1st, we are going to close the January account, but we couldn't enter some entries. Most probably those are genuine, right? First, we have identify error corrections. What is the error? Error is, one is positioning error, casting error is there. A credit sale of 50,000 was correctly debited to the receivables account, right? We'll write it here. Error the credit sale of 50,000 correctly entered in receivable account, but what is the next account? We are going to enter the sales account. We are going to credit the sales account, but sales account credited only, what is it? 30,000. 30,000. This is the error we have detected. In addition to this error, there may be some adjustments what we have detected for the last month, for the last accounting period, right? In this example, it said there is a adjustment of accrued expense, right? One is adjustment 1. Adjustment 1, it says, what is it? Unpaid electricity bill of January. Unpaid electricity bill for January. This is accrued payment, right? Normally the bill is receiving after the billing period. January electricity bill we are receiving in February, right? Then this is accrued expense. In accrued expense, we have to enter unpaid electricity bill for January. Amount is 4,000. Amount 4,000 rupees. You note down this, right? I am going to delete this. I don't have sufficient space in the whiteboard to extend this table. Now, once I finish these adjustments, then you note it down in a piece of paper, right? Then refer that to prepare the balance part of this account, right? Then there is another adjustment that is prepaid. This is adjustment 1. Adjustment 2 says, what is it? Adjustment 2 says, out of the rent paid, right, there is a rent expense. Rent expense is 30,000, right? But in this 30,000 rupees, we have paid, but 6,000 pertain February. Now 6,000 of this 30,000 is relevant to February. Then we have to enter that 6,000 in the February account, not in the January account. This is another adjustment, right? Prepaid expense, that is out of the rent. Out of the rent, right? Out of the rent. 6,000 pertain out of the rent paid. 6,000 rupees 6,000 rupees pertains to which month? To February. Pertain to Feb. Right. Now we have to adjust this unadjusted trial balance with these adjustment and error corrections. What is the first error? The credit sale of 50,000 correctly entered in the receivable account, but sales account credited only 30,000. But there is a 20,000 rupees lack. That value we have added as the suspense account. Right? That is the value we entered into the suspense account, that we have balanced the unadjusted trial balance temporarily. Right. There are two adjustments. One is unpaid electricity bill for January amount, that is 4,000. This is a type of accrued expense. Accrued expense means certain utility bills we are receiving after the accounting period. Right? For January 1st to January 31st, electricity bill or water bill we are receiving in February. Right? But that expense, even though we spend as in February, that expense supposed to go to the January month account. Right? We have utilized those in January. Right? Then this is that adjustment. Adjustment on unpaid electricity bill for January amount 4,000. Adjustment 2 is out of the rent paid, rupees 6,000 pertains to February. We have paid 30,000 rupees as the rent, but only 24,000 rupees applicable for January. Balance 6,000 rupees that's supposed to go to the next month. That means the February month. 6,000 rupees. Right. Note this down. Pause the video, take a screenshot or write it down and read again. Right. Now for this, I am preparing a rectification of errors and adjusting journal entries. Next step, right? Errors and adjusting journal entries. Right. This is another small piece of journal entries for error correction and adjustments. Right. Date. Right. Date. Details. Date. Details. And debit and credit. Debit. Credit columns. There is no doubt, for all these transactions, date is January 31st. Right? Date is January 31st. Jan 31st. First we will enter what is the error. Now we have credited suspense account by 20,000. Right? Suspense account by 20,000. Now this credited account, we have to debit it here. Right? January 31st, suspense account. Suspense account, we are debiting by 20,000. Right? But the sales account, we have to credit it by the same account. This is a credit sales. Then another account hit on this transaction is sales. Sales account we credited by 20,000 rupees. This is the first journal entry for error correction. If you want, you can put a narration here. Error correction. Error correction. Or you can provide detailed narration here, right? Rectifying under credit rupees 25,000 in sales and clause in the, you can say error correction, or you can say clause in suspense account. Right? Clause in suspense account. Put it in brackets. Right? Other two entries are adjustments. Electricity expense account, right? January 31st. Electricity expense account. We have to debit by 4,000 rupees. Debit by 4,000 rupees. And there is another account, accrued electricity expense account. Accrued electricity expense account, that is credited by 4,000. Right? And rent has prepaid January 31st. Next is prepaid rent account, that is debited by 6,000. Right? Another, the rent expense account to be rent expense account. What we have debited here, that to be credit. Right? ₹6,000. Right? These are adjustment entries, adjustment journal entries. Right? This is another account. Right? Another part of this process. Definitely we have to prepare this. And there is another one before that. Same way, north is down and north is down, write it somewhere. Next part is we have to provide the suspense account. We have to say this is set off. Right? Suspense account. Show the T account. DR and CR, suspense account. What we are going to do? Sales account. We have debited 20,000. This is the way we are going to close the suspense account. Right? And initial trial balance. Initial trial balance variance, that is 20,000. Now this suspense account, that is closed. Total 20,000. 20,000. right? Balance equal O, 0, right? Balance equals 0, right? Okay, then we can extend this trial balance as the final one. Okay, now for this adjusted trial balance, this is the format, right? This trial balance, adjusted trial balance, we are not going to put dates one by one, right? Account title. Account title is there, right? And we have initial situation, that means unadjusted balance. Unadjusted balance. And we have another column, adjustment column, right? And final amount. Final balance, right? Final, we'll say final adjusted balance. Right. First, we'll go for debit entries, cash account, trade receivables, purchase account. We don't have any adjustments, right? Cash account, right? Sorry. And divide each column to 2. This is debit, this is credit. Divide this is BR, this is CR. Divide this is DR, debit and credit. Right, debit, credit. Cash account, right? In the cash account, we have 30,000 initial, in the unadjusted balance sheet, we have 30,000 debit balance. Right? No adjustments, that 30,000, sorry, 300,000. That 300,000 you can get as the balance of final adjusted balance. And the trade receivable, there's 120,000 debit balance, right? It is going here, 120,000 debit balance. Right? Then the purchase account, we have 200,000 debit balance. Purchase account, $200,000 then we can take that 200,000 here. No adjustments. Next is the rent expense account. We have rent expense account. In rent expense account, we have adjustments. What is it? 6,000 is relevant to February. We have only 24,000 amount for the January. Then what is the debited account? Debited amount is 30,000, right? We have 30,000 debit amount here. Then what I am going to do is I am going to credit, right? In adjustment column, I am going to credit 6,000 rupees, right? Then for this debit balance, right? For this debit balance, I am getting 24,000 rupees. 24,000 rupees. Why? I deducted the 6,000 from 30,000. Why? 6,000 is not relevant to January. That is relevant to February. Rent expense, right? Electricity expense. That electricity expense account that we didn't in the original TB, unadjusted TB, there was no any electricity bill, electricity account, right? This is new account. We have to add that electricity expense account. Right? Electricity expense account. Then I'm going to debit 4,000 in adjustment column. Add 4,000 and this 4,000 we have to add to the final adjusted debit balance. All right. Then again, prepaid rent account. Rent account, we have prepaid rent account. Right. Prepaid rent account. It says there is a 6,000 prepaid. Right. 6,000 prepaid. 6,000 prepaid. We are adding that to the debit balance. Right. And that I just want done. Prepaid rent account. Right. And the sales account, we have adjustment. What is it? That 20,000. Sales account, right? There's a 35,000 and error correction we have detected. This is credit balance. That's a credit balance 350,000, right? But there's a 20,000 missing, right? That was the error. Then we have to credit. We have to enter another credit 20,000. Finally, we are getting the credit balance 375,000. That is 375,000. 350, 20. 370,000, right? Sorry. Not 75. 370,000. And trade payables, no adjustment, 80,000. trade payable, that is 80,000. That is 80,000, right? And electricity bill, accrued electricity bill, that is liability, accrued electricity bill, accrued electricity bill account, right? Then we have to credit it. We have debit electricity expense account and 4,000 rupees we have to credit. Is it? No. Capital account is there, right? Capital account. Capital account. In capital account, there is a 200,000 credit. 200,000 credit. And here 200,000 credit. Finally, we have at the balance of suspense account, right? Suspense account, right? We have 20,000 credit balance. Accrued electricity bill, that is 4,000, right? $4,000 and capital account 200,000 and 200,000. Suspense account, $20,000. In adjustment column, we are debiting. Suspense account, we have to debit. Now that is closed. Right? And clearly we have to show the suspense account balance in the final balance is 0. Right? This is the balance sheet, adjusted balance sheet. And finally we can get what is the total. Get the total of these all columns, right? This is 300, 420, 420, 450, 650,000. Right? The total is 650,000. Next column, 358,000, 220,000. That is 650,000. $10, $20, that is 30. We have done 30,000 adjustments. That is tally. 6 for 10, 20, 30,000 adjustments. Here, this is supposed to be what is it? 3,420, 620, 648, 10,000, 654. Balanced. 370, 450, 650, 654, 654. Right? Then this is the way, right? Right. Now, this particular trial balance, this is the final trial balance, adjusted trial balance. This adjusted trial balance we can use for financial statements. We have to prepare accurate adjusted trial balance, right? Adjusted trial balance, that's to be accurate. Then all next financial statements like profit and loss account, right? And balance sheet and financial health statement, all these based on this trial balance. Then preparation of accurate adjusted trial balance is must in accounting, right? Then we will stop for today. I think you have understanding about passing general journal entries, passing general ledger entries, right? Providing T accounts and preparation of unadjusted trial balance, right? And the process of suspense account and how to close the suspense account and how to prepare adjusted trial balance, right? Now, this is, I think you have thorough understanding about that. If you have any doubt, you can contact me with the number displayed. And if you want further assistance, we have all prepared tutorials. If you want that, you can send me WhatsApp message or join the WhatsApp group indicated in the description box, right? Thank you very much for participation. We'll meet with another valuable lesson